Well, good day. My name is Kim Moody, and I'm your host for In the Mood with G C Moody podcast. And again, I've been a little bit sporadic on getting these podcasts done and what have you. It's just been crazy out there, both on the personal side and the business side and the economic side and what's going on in the world geopolitically. It's been busy, but I will attempt to get podcasts out more regularly. And today, I want to talk to you about a number of things. To focus on the federal budget of November the 4th, and as I record this today, it's December the 12th, 2025, coming up to the end of the year. And so the federal budget is a month and change in the rearview mirror. So I've written about it, obviously, but I haven't done a podcast about it. So I thought I'd do that today. And then, since today is December the 12th, which is the 101st day of the CRA 100-day plan, I thought I'd at least comment on that in this podcast as well. But let's start off with the federal budget. So the federal budget came out on November the 4th, and for those that need a reminder, it came out after a bit of heat was placed on the Carney government. When they got elected at the end of April, about a week later, the finance minister, Minister Champagne, said that, they probably weren't going to have a budget, and instead they would defer to a fall economic update. And, and so there's a fair amount of pushback on that. And so when Prime Minister Carney was in Italy during one of his many travels, he announced that, they would do a budget in the fall. And since that time, they've decided to change the budget cycle as well, which the budget cycle is now not going to be the spring, it's going to be the fall. And for those that need a reminder on that little announcement, and I've written about this as well in one of my Financial Post pieces, the government's fiscal year end starts on April 1st annually. And so that means it ends on March 31st every year. So it's not a calendar year end, it's March 31st. And so that's the reason why the budgets historically have been released in late winter, like February, early March, or early spring, end of March, just before the new cycle. And in some cases, early April, just before, just early on in the new fiscal year. There was in 1985, and in the midst of me writing about this, I tripped across a really insightful piece that was put out by the government at that time. Michael Wilson was the finance minister, and they contemplated improving the budget cycle. And one of the things they talked about was maybe, what is the right date for releasing a budget. And so they actually did a decent job analyzing all that. And one of the proposals was a fall budget, but they dismissed it because they thought it was too far in advance of the April 1st start of the next fiscal year. Because by definition, a fall budget, the last day of fall roughly is December 21st, which is the start of winter. Yes, I know it can be plus or minus days in there, but which, when you think about it, let's say that it's mid-December. Well, you've got January, February, March, and then roughly another half month in April. That's a long time to do that in advance, 3.5 months in advance. And so they concluded that in that 1985 paper that a good budget cycle would be in the winter, usually mid-January in February. That's what they concluded. And it's been roughly that way ever since. And in one of my writings, I blasted the Trudeau government for not having a budget in 2020 during the COVID years. The first time in Canadian history that we didn't have a budget. And you think about that. Our country was born in 1867. Lots of challenges along the way, including First World War. Even in 1885 with the Riel Rebellion, and we had First World War from 1914 to 18. We had the Great Depression that started in 1929 and went until the mid 1930s, and then we had First World War 1939 to 1945, and then we had the Korean War 1950ish. We had the Cuban Missile Crisis in the early 1960s, and we had gas shortages in the 1970s. SARS in the early 2000s. To have no budget in 2020 was absolute ridiculous, and I stated at the time, I stated again, and to suggest that we weren't going to have a budget in 2025 was further, it was just horrible. So at least we had a budget on November the 4th, but do I think that the changing of the budget cycle is good? No, actually I don't. I don't mind it being well in advance, obviously, but I think it's too far in advance. I like the 1985 paper conclusion to have it in early, in late winter, and that to me is a much more logical time. Now, there has been a fair number of supporters that disagree with me. Even the parliamentary budget officer seems to think that fall is good. And I like a lot of things that the PBO has to say, but in this case, I just don't agree. I think it's going to be, like, if you come out with a budget like they did on November the 4th, let's say in October, that's just too far in advance. Yes, they're going to have a spring update, I get that, but I'm just not a big fan of that. So with that aside, what did the budget of November 4th have? Well, I'm just going to refer to our firm's notes on this, and I'm just going to look over to this other screen here. But, as we said in our budget summary, which if you want to take a look at it, it's moodysprivateclient.com. So, if you want to play a drinking game by taking a shot of alcohol for every time the budget mentions the word invest and the vacuous phrase spend less to invest more, you'll be on the floor very quickly. That was meant to be somewhat humorous, but there's a lot of truth to that. This budget is full of vacuous phrases intended to, it's very partisan, like a lot of budgets are, frankly. This one is one of the worst, though. Spend less to invest more. That goes to the whole separation of the budget into operating and capital, which I'll talk about that more in a bit here. So on the economic side, projected total deficit for the 2025 year is, the 2026 year, which remember ends March 31st, 2026, expected to be $78.3 billion. I get that today's day and age, people get numbed, especially, with billions here, billions there, trillions there, millions here. People that are not financially literate get really numbed with that kind of stuff. The average person has no idea what $76 billion means. Let's just put this in perspective. Let's say an average hospital would cost $1 billion to build. Just an average hospital. Yes, there can be a lot more. That's 76 hospitals that you could build. That's a lot. And that's a deficit of 70. I said 76, it should be 78. Public debt charges, that's interest on our debt, is expected to increase to $55.6 billion for this coming year, to $76.1 billion in 2029-2030. Again, think about that in the number of hospitals. 76 billion in public debt charges. That's 76 hospitals. And so we have an overall deficit of 78 billion and public debt charges in this current coming year of 55.6 billion. And do Canadians get anything out of public debt charges? No. They made a big deal in this budget about, and the media was nice facilitator of this, that there is going to be some austerity and cuts in costs. Well, the total cost cuts apparently is going to be 60 billion over the next 5 years. You think about that, 60 billion over the next 5 years. That's pretty minuscule in the whole scheme of things. But new spending is going to be over 450 billion. So that's like saying you've lost weight when you've actually gained weight. That's so misleading, which kind of gets to the whole separation of the budget into operating and capital. That's very misleading as well. Frankly, it's deceptive. So on the tax side, what did the budget have? Well, thankfully, no personal or corporate tax rate increases, and frankly, there was no adjustments whatsoever. Yes, there's the 1% reduction on the lowest personal tax bracket, but that was introduced right after the election in the brief spring sitting, so that was not part of the budget. They eliminated the underused housing tax, which is a good thing. That was a very ridiculous intrusion and a data grab into our system, introduced in 2022 under Prime Minister Trudeau. Thankfully, that's gone, because it was nutty from a policy perspective to begin with, but the administration on that was just horrible. During the election, they made this big announcement, well, big in my world, that they were going to reintroduce an old tax shelter called the multiple unit residential building, or what we tax geeks used to call MERB, that originated in the 1970s to try to incentivize housing construction. And when you look back on the history of that, it had a very iffy history and utilization and effectiveness, and nothing in the budget on that. So in my view, that's a good thing. They eliminated the luxury tax for planes and boats, but for some reason not cars. I have no idea why. The luxury tax is it's very political. It doesn't raise hardly any money, and as a matter of fact, it's had a detrimental effect on certainly these industries that are, I have some clients that are in the automotive industry, and certainly they've seen an impact on the declining sales of some of their luxury vehicles. And I'm certainly well aware of some people that keep their boats outside of Canada and don't import them into Canada. So thankfully, at least boats and planes have gone away. But given the struggles that our automotive industry has had, I would have expected that they'd eliminate that as well. But nope, for some reason it's there, and hopefully that comes later. They did commit to increase the capital gains deduction limit, which was announced in the notorious 2024 budget. As part of the capital gains inclusion rate increase, they're going to increase the capital gains deduction to 1.25 million. But when they eliminated the capital gains proposals, effectively back in January, pre-election, there was always the question of, okay, what are they going to do about the capital gains deduction? Are they going to keep that effective June 25th of 2024? And the short answer is yes, they are, which I think is a good thing. But they are going to get rid of the ridiculous Canadian entrepreneurs incentive. I mean, that one I've commented on many times. That was kind of again, some sort of idiotic incentive that some bureaucrat or somebody decided to invent, where they're going to allow reduced capital gains inclusion rates if you disposed of a certain industry. So the issue is, they're going to define what the good industries were. So it starts off with, here's the good industries. Try that again. Here's the excluded industries, is what I meant to say. And the exclusions were very, very long. So, for example, if you're in the tourism industry and you ran a hotel, nope, you're out. If you're an evil professional services person, like an accountant or a lawyer, nope, you're out. And very, very awful policy, and thankfully they got rid of that. They are apparently going to reform and modernize Canada's transfer pricing rules. They are going to limit the deferral of refundable tax on investment income through tiered corporate structures. That one's an interesting one. It's pretty technical. I won't get into it on this podcast. I'll just say that the draft legislation that they've released on this is, I think, problematic, and I know a number of people, including me, are talking to the Department of Finance on that one. They've reinstated certain accelerated investment incentives, as they're called, for for certain types of expenses. They've this one's interesting. They're allowing for an immediate expensing of manufacturing or processing machinery or equipment or buildings associated with that. That's interesting because the normal CCA rate is 4%, but the short story here is how many buildings are going to qualify because of our, in Canada, how many manufacturing and processing industries are there, or businesses? I would say, yeah, of course there's some, but it's not very widespread. I think that's pretty much, there's a whole bunch of other little nits and gnats here, but that is pretty much the highlights on the tax side of the budget. I think the key that I wanted to get across today is that, the economic side trumps much more the tax side. In other words, the spending is something that Canadians really need to get their head around, because this is going to have long-term impacts, and the impacts are not going to be great. It ultimately, as I've written about, it's going to be our future generations that will pay for this, with increased debt costs and concerns about the fiscal sustainability. The parliamentary budget officer has made some pretty blunt comments about the fiscal path of our current government and the previous government of Trudeau's on how much money was being spent, in my view, recklessly, and because you've only got a number of choices. And Chrétien, Prime Minister Chrétien back in the 1990s faced this very concern. We had huge debt and high tax rates. And I have to say, back then, there were some hard choices that were made, but some good choices. Lots of cost cutting, and significant tax reduction. And the combination of the two really got Canada back on the fiscal path that we needed. And in my view, we're setting ourselves up for that again. But I think the hurt is going to be a lot worse, because the out of control spending that we have needs to be quelled by a combination of cost cutting, of course, which the cost cutting efforts made in this current budget are lipstick more than anything, in my view. They need to cut a lot more than certainly what's there. And secondly, the government's going to need extra money in order to pay for this, and to ensure that that government programs that are necessary can be done. Like, for example, old age security. Old age security is a huge part of the amount of money that's paid out as part of the government revenues that it collects. Off the top of my head, in 2024, it was $459.5 billion that was collected by the federal government. And just to digress for a second, of that $459.5 billion, 47.7% of that, or $217.7 billion, was collected from personal tax. So that is a huge reliance on personal tax. And I think we need to shift away from that, but because that hurts us, in my view, as a country. We need to look at other sources, like increased reliance on the GST. As much as I love the conservative policy, the fiscal policies of the conservative government under Stephen Harper, that was one thing I did not like, was the reduction of the GST from 7% to 5% that they did back during his tenure. It was political, not very good policy in my view. And I think we need a rethink on that. But going back to this analysis, $459.5 billion of federal revenues, old age security, I can't remember the exact number off the top of my head, but I think it's approaching $80 billion. That goes out as part of those revenues collected. I think I'm a little high on that number, but it's in that neighborhood. I wish I had it handy here. But I know it's projected to increase to almost $100 billion in the next little while here. That does draw into question the sustainability of old age security. Is there something we need to do to get that number under control? Or better yet, how do we control overall government spending so that we don't need to have continued tax increases? Because that's where we're heading, ladies and gentlemen, is without a control spending, we are going to need to find alternate sources of revenue, which means broader based taxes, maybe even increased taxes, which is really going to call into question our competitiveness as a country, especially when we have the gorilla south of the border being the United States, which has much more competitive personal tax rates on average than certainly Canada. So those are things that I worry about. Let me go to the capital budgeting side. And I've commented on this a lot, so I'll make my comments rather brief here. But this was the first budget which showcased the separation of the capital budget from the operating budget. And apparently their fiscal anchor, going away from debt to GDP is one of the, much comparable fiscal anchors around the world. No, their fiscal anchor is going to be, can they balance the operating budget within 3 years? Well, the short answer is sure they can, because the definition of capital is so broad that they released it on October the 6th on the Department of Finance's website. And as I wrote about this in the Financial Post and some other writings, it is so out of step with norms, public sector accounting board standards, or even just standard definitions of capital that you take in accounting 101 classes, that the definition of capital, you can pretty much square anything into capital. Let me give you an example. Included in the expanded definition of capital for budgeting purposes is the tax expenditures that apparently contribute to capital formation. So first of all, what's a tax expenditure? Well, let's say the government, which they did in this federal budget, they came out with some new tax credits and incentives for, let's say, green. Our Liberal government is famous for wanting green stuff. And so let's say that they're offering a tax credit for carbon capture, as an example. And they project that this new tax credit for carbon capture is going to cost the federal government $1 billion in lost tax revenues annually. Well, if it's $1 billion annually, then that will be a tax expenditure. And if they think that that is part of capital formation, then that goes to the capital budget. Now think about that. Pardon me. Think about that for even 2 seconds. That is, under normal principles, that is definitely not a capital asset. And certainly under public sector accounting standards, that is not. My apologies. But it's going to now form part of the capital budget, which means that it takes away from the operating budget, which means that the operating budget, it looks so much better, doesn't it? Because it's reduced because of that tax expenditure. It moved off that column. Ladies and gentlemen, that is classic manipulation of budgeting. As I wrote about, when during the Liberal leadership coronation back in February, March of 2025, and Carney came out with an announcement that if he becomes leader and prime minister, that he would introduce this new budgeting. I did a piece on this and did a little history, and going back to when double entry accounting came into being by Pacioli, the Italian mathematician. And I like double entry accounting. I think it's served countries very well over the years, but it is manipulable. And this is one of the many, many manipulable things, is the whole definition of capital versus expenditure. And unfortunately, because of Carney's reputation, where he's such a brilliant guy, that people will accept that this is a good thing. because of his brilliance. Well, ladies and gentlemen, this is not brilliance. This is simple deception. And I really hope that Canadians wake up that, just because you're putting something from the operating budget into the capital budget doesn't reduce overall spending. There's still debt associated with it. And that ultimately is what matters is debt. And so with that, I'll get off my little pulpit because I've spoken and written on this a lot, but I do think this is very dangerous. It's a very shoddy, fiscal anchor, if you want to call it that. I think it's ridiculous, actually. It's embarrassing that this is even a fiscal anchor. If you want to have the fiscal anchor achieved within 3 years, just do it next year. You can take a whole good chunk of monies and put it into the capital budget tomorrow. And fiscal anchor achieved. Yay. And so that's that's something that, even the parliamentary budget officer last month came out and said by their quick analysis, $92 billion was, from their perspective, put to the capital budget that shouldn't have been. And that's just classic in my view. So that's it. What do we need in terms of steps going forward? Well, again, I've written on this many times, including my latest piece in the Financial Post. We need tax reform. During the budget, during the election of earlier this year, the Conservatives came out with a promise that if they got elected, they would have a tax reform task force. And the devil would be in the details, obviously, but I thought that was a pretty good idea. And the Liberals copycatted the idea, but only partly so. They said that they would come up with an expert review of the corporate tax system. Well, of course, the November 4th budget had nothing to do with that. And the reality is, the Liberals want nothing to do with tax reform. In their view, I'm sure it's too politically dangerous. And the tax system works fine right now. I'm sure is what they think. But the reality is our tax system is bloated. It's too complicated. The administration is unfortunately unapproachable for most Canadians, which is a nice lead into the 100-day plan of the CRA. And I'll end the podcast on this. So just a quick reminder, on September the 2nd of this year, I rolled out of bed and was in the midst of my work day, and then all of a sudden I see this Twitter that comes across my social media feeds, and it's a post from Minister Champagne, the finance minister, and also the national revenue minister, who said that that Canadians deserve better from the CRA in terms of its call center performance and overall service standards. And I thought, wow, that's kind of refreshing. And he's ordered the CRA to come up with a 100-day plan on how to do it. And I thought, wow, geez, this is kind of interesting. Because certainly there's no doubt. I mean, anybody that's tried to get a hold of the CRA through their call centers knows that it's just really, really difficult. And it got noticeably worse, especially in the last year. And, and some of those things, for example, are, the CRA employees working from home and, taking the calls on the cell phones, and then the cell phone drops and they don't call you back, which I always found rather crazy. Like, why don't they call you back? Is there some sort of security issue on them calling you back? I found that just nutty, but that's just only one thing. And so, no scheduled callback system, and I could go on and on. So this 100-day plan, I thought, okay, well, let's see what they do. I mean, first of all, it's obviously this is very political. Nothing's going to materially happen in 100 days. Fast forward to day 50, roughly in October, and all of a sudden the Auditor General releases a report on the CRA call centers and some of their service standards. And it was a very scathing report, and it was unbelievable, actually. And so then all of a sudden it's like, I see what's going on here. The CRA was obviously, along with the minister, given an advance copy of the Auditor General's findings and report, and so they wanted to get ahead of it so as to quell any damage. And so that was the whole impetus, obviously, of the 100-day plan. And so, again, very political as opposed to, if you really wanted to do some improvements, it wouldn't have to take an Auditor General report. They would have done so proactively and responded to the legitimate complaints of taxpayers and the tax community, which has had issues with call centers and CRA performance for years, not just recently, but for decades in the whole scheme of things. And so fast forward to December 11th, which is yesterday, and it was the 100th day. And so did I expect anything miraculous? No, of course not. And I did try calling them in the morning, seeing if there was noticeable improvements. No. I still get the computer-generated voice. Oh, it drives me crazy even listen to this so-called person direct traffic. And had a hard time getting through. And so I did a little video I posted on my LinkedIn account as well, with the conclusion being that the CRA, despite they came out with a press release, a very self-congratulatory press release yesterday on saying that this is all the progress they've made. Well, with respect, the progress they made, yes, there's some, but it's all treating the symptoms. It's not treating the root causes of the systemic issues that the CRA has. They really, really need to look at improving service standards. I mean, during the 100-day plan, they had a goal to respond to 70% of calls. 70%. Like, think about that. And I don't care if their response rate was a lot less than that before. 70%, it should be 100%. And in the midst of, there was some commentary yesterday that the CRA will never be able to respond to 100%. What? Well, you better, because Canadians deserve more. You are the largest bureaucracy and employer under the Canadian government. You have 55,000 employees, and you can't answer calls? And maybe look at why people are calling you to begin with, and why those calls continue to increase. Go to the systemic and root charges. So, in any event, it was a joke. Will continue to be a joke until the CRA legitimately looks at the systemic and root issues. So with that, ladies and gentlemen, that's my comments for today. Hope you enjoyed it. Always enjoy feedback, whether it's constructive or positive or hopefully not too negative, but feel free to reach out to me and have a great, if I don't chat with you before the Christmas holidays, have a great Merry Christmas, and I look forward to chatting with you in 2026 as well. But, if I'm actually a little bit organized, I might even bang out another podcast before that time. But if I don't, have a Merry Christmas. Look forward to chatting with you in 2026. All the best now.